Hi, I'm Peter Rose, founder of Longwood Currency Trading. How to manage your Forex trading during market uncertainty. Man, if you don't understand this management of your money during these times, and you're trading on intuition or Fibonacci's or whatever it is that you're doing, you're going to be in deep trouble. Just another reason why I am not a fan of indicators, and as a day trader, particularly not a fan of indicators. By the way, if you're a long-term position trader, what I have to say probably won't interest you. I work on day trading because I want to be done at the end of the day. I want to be flat. I want to know exactly what my P&L is. I want to be able to control my risk, and I cannot control my risk if I have to go on a sleeper, on a carry trade. I want to be at the trading desk. I want to see what's going on in market action, not relying on the news or what I think, or it's Tuesday or NFP is coming out. I don't want to think about all that stuff. I want to be there managing that trade. So I have to be aware of the uncertainty that lies in the market. So that's sort of what we want to talk about today to get that clear, I guess. Clear. How clear can it be? My French press coffee I just finished fixing. It takes entirely too long. You gotta boil the water and then 6 minutes to brew. Whew, man, but it's really good. We're middle of June of 2025, and as you can see, it's a little foggy and clouded. Yesterday it was beautiful. Sue and I went down to the beach up in Wells, and while she hunted around for sea glass, I sat in a deck chair and I'm reading a book on a commodity trader that was one of the last folks that traded in the commodity pits in Chicago in the sea butt. And we had a great time, and then we went out to dinner and set up on a third floor outside deck over a beautiful boat moorage cove, and it was just really a really nice day. And then overnight the clouds came in, and here we are. There was no uncertainty in that day. We were going to go to the beach. The weather report was out and said that it was going to be nice. We didn't have to worry about the rain or too much wind or whatever. We knew the path, the road to get there. We knew how much gas we had in the car. We knew what time we had to be at the restaurant for our reservations. We knew that it was going to be outside, so we could wear a little heavier jacket because it was a little chilly, because the wind was, you know, it was probably I don't know, in the mid 60s. And with a 5 or 6 mile an hour wind up on the third floor, yeah, we knew it was going to be a little chilly. So we're constantly doing things that remove uncertainty, the possibility of uncertainty, from what could be a very uncertain process. You can't just get out and drive in the car because you're going to go 20 miles somewhere and go, oh, well, you know, it's north somewhere. You have to pull out your GPS or map or whatever it is that you have, and you have to look at it. You have to say, well, it's going to take us X amount of time to get to here and X amount of time to get there, and it's this time of day, so is there going to be any commuter traffic or anything we need to concern ourselves with in? Because we needed to plan things out because we had reservations at the restaurant. And if you don't show up for your reservation, it's $25 a person penalty. So you don't want to be late. So we removed the uncertainty. Let's look at the Forex market. The most dynamic market in the world, with the highest degree of uncertainty. The market isn't uncertain. There's a misnomer in my title here. We're uncertain about what we're seeing in the market. So we have to be able to unscramble in our minds what makes us uncertain about what the market is doing. If you're under a duress of any kind, that's a big uncertainty. And there's not much you can do to control that. So if you're not experienced, you probably ought to step back from the table, push back, and just watch the little squiggly lines move around on the chart until you feel, for whatever reason, that you're not uncertain, because you shouldn't trade if you're uncertain. If you're feeling that the market is uncertain, it's you. And so the real problem isn't with the market, it's with you. And because we're human beings, we're always uncertain, we're always chaotic, we're always moving around and at Mach 1, hair flying back, and life is busy and crazy and uncertain. So how do you manage yourself? You can't manage the Forex market. And it's very difficult to manage ourselves. But it would be tremendously more difficult if the market itself was just, it didn't make any sense. Well, Peter, I don't see that the Forex market price action makes much sense. If you're on a random walk theory, then you find this tremendous randomness in the market if you don't understand order flow. Once you understand order flow, then the market is not random. There's a reason for that. Can you ferret out that reason? No, because that would have to have precognition of what that order flow is going to be. That's why the institutional traders don't lose money, because they've got the order flow figured out, because they're the one putting in a $800 billion order or a $2 billion order for engine parts or something. And they know what the effect that is going to have on the market, if any. It's a $6.7 trillion a day market, so somebody dropping in $3 billion order isn't going to tag that very badly. But it could in the interim, because the retail traders could go into a panic, and right now we're only probably about 5% of the market. Back when I started looking at the Forex market in 2007, when the market was, I think it was $3.4 trillion a day, the retail market made up about 15% of the daily volume. And I think now at 6.7 trillion, I don't think the retail traders have made up for that. In fact, all the goofballs have gone off and they're trading currencies, so that, crypto. So the currency market is thinned out a little bit. So there's probably 5% of the volume attributed to retail traders. Now, some of these retail traders are pushing $3 or $4 or $5 million orders around. That in itself isn't that big. The Forex market can handle that, of course, and that's why. But that's why the brokerages themselves, because they're not interbank market participants, they're taking the other side of your trade, and then at the end of the day, they're flushing it out into that interbank market. So they put a limit on you of I don't know. I think it's maybe 100 lots or something like that you can trade at any one time. Some of them will let you do 100 and then maybe another 100. 100 lots is probably at 10 to 1 leverage is $1 million of bank. So even a really big retail trader, and there's probably only, maybe a dozen of them that are trading $3, $5 million, $8 million accounts and pushing that kind of money around in the market. Yeah, you might have some people going in $30,000 positions every 5 pips or every 3 pips or something like that, staging into the situation so that at the end of the thing they have 800 or 900 lots into the market. So that the retail traders aren't really causing any disruption in the market, because the institutional traders are so large and they're pushing so much large money around, and the retail trader is about 80% chance that you're wrong, and so the institutional trader is simply taking the other side of your trade because you're wrong and they're right. The institutional trader is never wrong. They're always right, because they're either buying currency for a client or they're selling currency for a client to satisfy the client's needs to buy engine parts and trade his currency into the currency of the country that he wants to buy the engine parts from. That's the order flow. That's why they're never wrong. Oh, they could get caught and they can end up wrong with their client because the market just was moving so fast in a particular direction that they couldn't fulfill the client order at the price the client wanted. So it's very difficult for the retail traders to count on what's going to happen in this roaring market, because all of a sudden the institutional trader stops his buying and says, yeah, I'm not going to, my client isn't going to pay any more for that. And if you understand order flow, you'll see that that's where these bands of congestion come from. They just don't want to do that anymore. So as a retail trader, you have to look at what the order flow is so that you're not uncertain about what's going on under the sheets. It just isn't because the fucking price is moving up. It isn't. It's why is the price moving up? And why is it moving up now? That's that third component of question that I teach in my courses and my consulting as to the way that you solve any problem. And God knows the Forex market is a huge problem. But you have to know what to do, how to do it, and you have to know when to do it. So in your mind as a retail trader, you see that the price is going up. Why is the price going up, and why is it going up now? What's going on behind that? That's what's causing the uncertainty in us. So the solution to how to manage your Forex trading during market uncertainty is to recognize the market is not uncertain, that you are. What is causing that uncertainty? It's the price action that's going on that doesn't make sense to you. If that's your case, send me an email and we could chat about that. No pressure to buy a course. I don't sell coursework. I don't want to work with 100 people. I'm not trying to make 7 times my trading income on courses. I'm not running a training business. If I can help you by pointing you in a direction or answering some simple question you may have, that's great. And I get to meet you, and I have people that I've done that with, and we still remain in contact with each other, emailing back and forth. That's great. Well, it's fun for me to be able to work with folks. I've been an educator for over 50 years in martial arts, teaching people important stuff like self-defense. This is just freaking money. This is easy. So if you have questions about that and how maybe, I can't answer it in a video for you because I don't know you. See, that's the problem with a lot of these videos. They're going to give you these rules. They're going to give you, this is what you should do. How do I know what you should do? Are you 24 years old or are you 54 years old? Do you have a lot of money behind you or reserves? Or are you trading a $3,000 account because that's all the money that you have in the world and you're hoping to God that you don't lose it? Are you a physical laborer getting into this? Or are you an academic, a theoretician? Because each one of those people deserves a different answer to the specific question they're asking. That's the educational principle. So I can't help you in a video because it may not be applicable to you. All I can tell you is that the market is not uncertain. It's your view of the market that causes uncertainty in you. And the way that you resolve that is by better understanding order flow. I can explain to you what the order flow is and how it works, but that when component is the critical part that nobody out there seems to be teaching. Anybody that's teaching you Bollinger Bands or Fibonacci's or RSI or any of that stuff is not talking about order flow. Now, you might be able to get away with that shit in the stock market, but you're not going to get away with that in the currency market. The bank traders, the institutional traders, that laugh at the retail traders. They don't use indicators. They just laugh. But they look at the charts and they see where the fib levels are and all that stuff. And they go, oh, these dumbass retail traders, that's where they're going to be. My client needs prices that are going to be above that. So if I buy into that, those guys are going to panic and they're going to be selling out. So I've got the liquidity that I need. Not much of it, but if you're trying to push a $3 or $4 billion order through, every little bit helps. And if you got some dumbass that's going to walk out in the middle of traffic, you got to hit him. That's all it is. And when you get hit like that, it causes you panic. Oh, I didn't understand what I didn't know. I didn't read the fib right, or I'm blah, 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 all this crazy stuff. If you are trading up on the higher time frames, bring it down and trade on the daily chart so you get your results in real time where you can think about it and analyze that stuff. And you can write your transactions down so that at the end of the day, you can go back through and you say, I lost here and I lost here and I lost here, but I won. What did I do when I won as opposed to when I lost? And look at the chart. Look at the past price action in the chart. And why did you take the trade at that point? What made you think that you should take the trade at that point? And how does that price action and your failure to recognize what was going on that revealed itself 15 minutes later, why was that happening right then? What was the when component in the mind of the institutional trader that had them move the market to that price? Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.